Hi and welcome to our 8th episode of Property Investment Advisory's live stream. With me tonight I have a special guest, Mr. Mark Wilkins from Capital Claims, and also our compere and interviewer, Mr. Tony Vidre from AV Chartered Accountants. And we'll just start off handballing over to Tony. We're going to actually run some questions at the end, and as we've said before, no such thing as a stupid question, is there, Tone? So
never. No, only stupid people. That's a line out of South Park. So Mark, it's my pleasure this afternoon or this evening to interview you. Now, you're a quantity surveyor. Now, I would imagine that next to actuaries, economists, accountants, you'd be a real hit at a barbecue when people say to you, "What is it that you actually do?" So give us the elevator pitch. What is it that What are these dark arts that the quantity surveyors actually do?
Well, quantity surveying is a long-lived old profession that basically came down to the old days of counting stones. Quantity surveying is construction costing, so estimating construction costs and basically putting quantities together to put dollars against. When applying it to tax depreciation, a whole new set of skills come into that as well.
Yeah, so not only are you working out what it costs today, you're also going back you're getting in your time machine and you're going back at a particular point in time to work out what it would have cost to build that property back in 1990, 1996, whenever it was constructed.
Absolutely.
Yeah, and that's really the crux of what we're going to speak about today. So explain to us, I know why, but explain to people, why would an investor need to engage a quantity surveyor and what benefits will they get out of it?
Good question.
Okay. The process of estimating construction cost by a quantity surveyor is predominantly to allow an investor to reduce their taxable income.
Mm-hmm.
So there are a set of legislations around applying Division 40, Division 43, a lot of these terms that we won't need to go too deep into, but basically says that by holding an investment property, you're allowed to claim deductions against the construction cost, the original historical construction costs of a property.
Not today's. What it cost back then.
What it cost to build back when, and then forecast those going forward for annual deductions going forward.
Yeah. So the way that I see it, the report that you give the client and the accountant is your receipt for the client to be able to claim that for the next 40 odd years.
Yeah, that's a great analogy. Now, a lot of people typically know how much they've purchased a property for.
Mm-hmm.
You should know. It's a fairly big ticket.
Yeah.
But what is commonly unknown is what the construction cost of that property is, which is what the foundation of depreciation claims are all about.
Yeah. So let's do an example. So say someone purchases a property today, as you said, whatever they pay for it today is irrelevant. Say it was built, I'll run with 1996. So if it was built in 1996, so we were talking off air, so these rules came in the late 70s, early 80s, and there were some different percentages, but you're essentially looking at, say, nice round figure, $100,000.
Sure.
If that's what it cost back in 1996, you give us a report to that effect, and that client can essentially claim $2,500 for the lifetime of that property. So from 1996 to today, you've already lost a number of years, so it's whatever's left over those remaining 20 odd years.
Yeah, typically for the Division 43, the tin, tiles, timber component of your property, the structural allowance, which is what we're probably talking about here, is a 2.5% flat line deduction.
Yep.
Absolutely, 40 years
Yep.
from the date of construction completion through to when that taps
So
off.
if they jump in today, they've only got that portion of the 40 years that are left. So if you think about some numbers and tax brackets, so if you happen to be in the highest tax bracket, 47% in that example, $2,500 is probably worth an extra $1,200 a year as a straight tax deduction. In the 39-cent bracket, it's about $1,000. So roughly, how much does one of these reports cost?
Yeah, well, that varies depending upon the complexity of the report and the requirements to produce that report. Depending upon, so we're looking at a very old property, maybe a requirement to do a full inspection, full historical understanding of the property. We're looking at $600-700 to prepare one of those. Some other ones where a lot of information is provided to us, plans, cost information, contracts for build. We're looking at $300 to $400.
Even at $600-700, again, doing the maths, if an investor is paying that amount of money to you, they're locking in this extra refund of $1,000 to $1,200 every single year, assuming that they're still working, and they've got other income to offset it against. So it's definitely worthwhile to do this.
Absolutely. When we're looking at newer builds, the properties that have been constructed this year, the last 5-10 years, the construction costs of those, as you're probably aware of, are quite significant. We're looking at $200,000-$300,000 contracts, and when you're breaking that into 2.5% chunks, it's becoming quite a sizable deduction.
Yep.
And that's just talking about the one component of the structure of the building.
Yep. Did you want to jump in and answer?
Mate, one of the questions that I get a lot is like, who should actually ask for a depreciation schedule? Yeah. Like what investors out there should ask for ones, and who shouldn't bother?
Well, the old thing is you don't know what you don't know, and a lot of our time is taking up educating, bringing people up to speed with the details that they need to be aware of. We don't ask them to go out and do all the legwork, but they just need to know that we can make, or prepare these schedules to their benefit. So every property, I would say, is requiring one. Sometimes it's the accountant that might make the suggestion. It might be a property sales agent. It could be anyone in the sphere of influence around that the property investor.
Yeah, we were saying off air, I actually started working in 1982, roughly when these rules came in, and I remember asking my bosses at the time, why aren't we getting these reports? Anyone who could quickly do the maths like we did, it was obvious that it was, for the benefit of the client. I remember my bosses at the time that they just wanted to get the job finished, and don't worry about that, Tad. And I thought, we're missing out on some actual dollars here. It wasn't until I actually became a boss in 1990 that I thought, no, we've got to get this, because there's some significant dollars at play. And I was amazed back in the 1990s how few people, like, it was just one of these little known things that came along, and we went back 4 years and got some pretty nice refunds for people. So why should someone come to a quantity surveyor? Can't I just do that myself if a client comes along to me, and can't I go and estimate it, or can't
as an accountant,
can't someone just do their own research and DIY it online and figure out how much these things are worth?
By all means, if you've got a receipt that says this is what an asset cost, or this is what it costs to build, you're most of the way there. But there are a number of tax rulings. Tax ruling 97/25A.
Are you throwing tax rulings back at me?
Well, just ones that might apply to you.
Never heard of that one.
It says that accountants are not actually prepared or aren't in a position to prepare these reports. That's all about construction costing, as we're saying there before, and estimating, which is an accountant's.
And even if you buy something off the plan, there's going to be the land component, there's going to be the construction cost, there's going to be the builder's margin. I don't know anyone who's going to be able to strip all those away to come back to a cost. And at the end of the day, as you say, for $600, $700, $800, $1,000, it's going to cost you. It's certainly worthwhile. And again, in the world we live in now, where a lot of these things come under the microscope of the tax office, you want that that receipt to be that. You want that report.
You want it to be compliant. The fee also is obviously deductible.
Yeah.
And there is methodology which can be applied to maximise those claims as well. There is so much that can be done to ensure that you're getting the maximum deductions from preparing a report legitimately.
Yep.
One of the questions I have as well, which people ask, how many of those do I need to buy? Like, do I just buy one? Do I buy one every year? What do I need to pay for it for? How much does it cost? And those sorts of questions I get asked.
Yeah, that's not uncommon, and we have had clients that have actually called us back the following year after having prepared one the year prior and said, I need another one of those things from last year. Well, ease up. You've done it once, and that's typically enough to keep it rolling forward until any major renovations.
It's very ethical, you could have done a save as and changed the date on that, but
no, I think they cottoned onto that pretty quickly when they saw the same document coming back to them
with the same figures. So what about an existing property? Let's say a really old one. So it was built in the 60s, so there's no depreciation available on it, but someone buys it and they'll go and do $100,000 renovation. Now they've got the receipts for it, but how do you come into that? Isn't there a builder's margin in that, or can they use the receipts? They still need to get your services in those circumstances.
Yeah, once again, there is a level of detail there which we can apply things such as, we'll observe the builder's margin, but prelims and consultants' fees and other apportionables that can affect the outcomes. And typically, not everyone has the knowledge on how to break up a total construction contract. It may be a lump sum $100,000 contract, what falls into which division. And how
which is what we were saying before about the builder's margin, and there are some construction costs that are not eligible, which you know about. Part of the dark arts that I spoke about earlier.
It is too, and but it's all about making a legitimate claim and making sure that it is effective for tax minimisation.
So what about if somebody's doing a renovation on a property? One of the questions I'm asked a bit, and I don't really know the answer to be 100% sure, is that if they're doing repairs and they're doing, what sort of defines whether it's a repair or whether it's actually a claim that they can make, and is it yearly, is it 40 yearly, is it a diminishing effect? Or
Good question, and once again, a question that we're asked quite regularly, and they ask, can my accountant deal with that? Now, what do I need to do? How do you work with my accountant to make this happen? The repairs and maintenance aspect is typically applied to a property which has been held for a while, because now when a property is purchased, an existing older property, that's the condition it's purchased in. Any works that are largely done to it immediately are going to be considered as a capital improvement. So it's improving it beyond the position or the condition it was in when it was first purchased. So repairs and maintenance versus capital improvement, it's all about the timing, really.
so if I put a new kitchen in, for example, it's a capital improvement.
Yeah.
If I'm fixing a sink in a kitchen.
Yeah, well, if you're looking at, say, an old paling fence, the paling falls off and you hammer it back on, that's a repair. If you pull it down, put a new fence up, that's going to be an improvement.
Okay,
Yeah, I've often explained repairs as trying to return the object back to its original condition. As soon as you go beyond that, it's an improvement. Mark, some interesting changes came in roughly 2017, which has restricted the claims that can be made. Do you want to walk us through what happened in 2017?
Yeah, absolutely. There was quite a few anxious moments, I think, in a lot of property investors' minds around that mentioned in the budget of May of 2017. But it's not the first time there's been changes to the legislation. It's a continually evolving process, the application of new legislation. But in this particular one, it was largely around second-hand assets within a property, within a residential investment property. And it is only applied to residential property. Commercial is exempt, and it is only in application to properties that are held personally as opposed to commercially. So what it basically says is an asset, such as a plant and equipment item, carpet, hot water system, air conditioner, etc., those assets will not have a value for deduction or depreciation purposes going forward if it's already been previously used. So
just to again to expand that out a little bit from what I've seen. So there were two types, and you talk about division 40 and 43, but we won't bore people with those. So there's two different types. One is all the hard stuff, all the construction costs, what I call all the bricks and mortar. That's your 2.5%. That's that example of $100,000 to build and a $2,500 write-off. Then there's, in addition to that, what you're saying, which is all the plant and equipment, and that's written off usually over about 5 to 7 years. And that was a pretty juicy sort of a tax deduction because there were high dollar figures there, light switches, all sorts of stuff. I remember seeing on reports that were written off very, very quickly. In addition,
air conditioners,
in addition
ovens
to the
a lot of those assets there were typically written off maybe in the first year or go into a low value pool to be able to be written off over a very accelerated process. Now those assets, they still have got value attached to them as buying that property as a second-hand asset, but the ability to make those claims is now being put back until in application to, if the property is sold, to adjust any capital gain.
So to be clear, if you're buying brand new property, you can claim both.
Yeah, absolutely.
If you're buying second-hand property, you can only claim the structural, the hard stuff, bricks and mortar.
On an annual deduction, absolutely. The structural, the timber tiles component, only if those works have been done within a qualifying period.
Yes.
So there are a number of other dates which will come into application there as well. And typically anything which has been built within the last 30, 40 years will have those deductions available to them, heading back to around the late 80s, 87 is the cut-off period.
Yeah. The complication that I'm starting to see, or that I can foresee, is you've got a mum and dad investor, they buy a brand new property, and they can claim both, and both are claimed in their personal return for a number of times, for a number of years. Then all of a sudden, dad passes away, and then mum acquires the other half. So all of a sudden in her return, she's got the half that she purchased, where she can claim both types, but she's inherited the other half, and all of a sudden that other half that she inherited from dad is second hand, so she can only claim one part, not the other
Is that
part.
real?
Yeah, absolutely. Yeah. Oh, well, actually, is it?
Well, that's you're haven't here, but
That's what I...
that is the way we.
That's the way I
observe as
understand
well.
it. Yeah, it's just incredible maths that now needs to be done with halves of halves. Yeah,
Absolutely, and also if you lived in a property for a number of years and then rented out,
Yes.
similar rulings are applying.
Yep.
Even
Because
though
it's
you may
second
have owned it since new, it was second hand when it started becoming income producing.
yeah,
So
it's getting very
all of
complicated.
these things come into game
So,
as well.
I've got a couple of live examples, I guess, that are just recent to me. Somebody that's bought a property a couple of years ago, probably 4 years ago, lived in it for a couple of years and now moved to a location a lot closer to their work.
Yeah.
From both of your perspectives, because it tips over both sides of the fence. How should they go about it so that they can now claim, and also from a capital gains tax point of view, so that they're not confusing or muddying the line down the track?
I noticed you said 4 years ago, and then that's putting us right in
Yeah.
the position of
Sorry about that.
2017.
Yeah.
May of 2017 was it March
Yeah.
or was it June? So really, the date of acquisition is going to be fairly pivotal as
Yeah.
to what claims are available to them.
Yeah.
If it was prior to that magic date, those deductions may still be available for them to make claims against.
Okay.
So these things we need to observe, and we do discuss these with accountants to make sure we get these crystal clear in application for each individual.
So it does
case.
involve both
Yeah,
parties.
but if it's after that date, it's a second-hand property.
Yeah.
So you're only going to be able to claim the hard stuff, the 2.5%.
Mm.
So to answer your question, what actually happens in that scenario is when you buy a property, you move into it, you live in it for a while, and then you move out and you rent it. From the day you move out, your starting point for capital gains tax is the market value of the house at that particular point in time.
Yeah.
Then you engage Mark. He does a depreciation report, start to claim the
What if they don't get a valuation? Because most of them don't.
we get them to get a valuation when they sell it.
Yeah.
So similar.
So how do we know how much it was worth when they moved across from rent?
The valuers go back and have a look at what the market was
at
at
the
that
time
time.
they take
Yeah.
it.
But that's you deemed to. Yeah,
We're talking about dark art now. This is
the
capital
valuation is
gains.
there's a range, but
Yeah.
the valuers have to come in and you value the property at the time that you moved out. Do you want to talk about quickly about the clawback for capital gains tax as well? So this is a great concession, but in 1997 the government brought in a very interesting clawback if you purchased a property after May of 1997.
Yeah, absolutely. The capital gains has always been a concern for people with a property, and the concern is that there's a myth follows depreciation, is that you need to pay it all back at the end anyway. Now, we say there's a myth there, there's this element of truth to it. There is a requirement to make an adjustment, a clawback, but typically there are a number of things there which will be affected to minimise that clawback. But typically what we're looking at is the base cost of the acquisition of the property will be adjusted by the amount of Division 43, which is the structure of the building.
Yep.
Doesn't apply to the Division 40 assets, Division 43 only. And then we go through the process of understanding what discounts are available to basically reduce that impact on the property.
So let's do an example. So we've got a property in 1996. It was built in 1996. It cost $100,000 to build back then, which means we get to claim $2,500 per annum. We buy it now. If we sell it in 10 years' time, what you're saying is that we've been able to claim $25,000 in those tax deductions.
Sure.
So that $25,000 actually comes off the cost base. So if they've paid $500,000 for it, all of a sudden it's dropped down to $475,000, and then that's what you're comparing the sale price to.
That's the gap. The gap will actually broaden by that process.
Yep.
And then we're looking at discounts are available, typically maybe a 50% discount on that for owning for more than 12 months. Or there could be full exemptions in some other processes that need to be applied. So, that, as we say, is an element that we look at when we're preparing the depreciation schedule. This is how we get those deductions. This is how we ensure that it's actually going to be worthwhile preparing a report. We make sure that each one we prepare is going to be worthwhile. And when we're looking at the timeline of applying those same rulings, we're looking at discounted value of the dollar over time. So the dollar is actually much better off in your pocket today than it is for not claiming it.
Yep.
You're actually better off to do that for a number of different reasons.
Yeah, absolutely.
The other example I had was somebody that didn't even know about depreciation schedules, which is, I didn't know about it until I moved up here, even though I was renting my property down in Melbourne,
Absolutely.
which is, I don't think it's that uncommon that people aren't aware of it. But this gentleman hasn't claimed anything, owns the property since 2000, I'll make it easy on you, 18, and he's now getting a depreciation schedule which was ordered today. So how does he go about it? And again, I know I'm asking both sides of the fence question, but
Well, you're first.
We would
Get the report first.
prepare the report, and we would always prepare it in the same sort of fashion, regardless of whether we're preparing it for that property, if it was built today or was built 2 months ago.
Yeah.
We apply it to the construction period, the construction costings of the time, and the report is forecasted in a similar sort of fashion. So what we'll typically find is there may be a number of years of amendments that can carry forward for that client, and that's the process the accountant picks up and follows through, because we pass the baton over once we've prepared the report. And
So once we get the report, we have to jump on and have a look at when the returns were lodged, because most people only have a 2-year window of opportunity to go back and amend. There are some circumstances which allows you to go back 4 years. Tax office seem to have a very odd way of processing. I've got one on my desk at the moment where we've gone back and asked for amendments for 4 years, and this was definitely a 4-year taxpayer, and they've come back and said, no, you've only got 2 years. And the pattern of behaviour seems to be that if you are asking for a refund, they come back and say you've only got 2 years. But if you've got a payable, they seem to process all 4, all 4 years. So we've got to go through a process if we're trying to explain that you've actually got 4 years. So it's usually 2 or 4.
Through the process of beneficiary of a trust type thing.
Correct. There's a few exceptions. Yeah, beneficiary of a trust is the big one. And in fact, that's the one that I actually learnt recently. I always thought you had to be a beneficiary of a trust and actually have received trust distributions. But the legislation doesn't say that. It just says that you have to be a potential beneficiary of a trust. And that's the bit they don't know. So I don't really understand how they would know to restrict the 4 years. So it's interesting.
How so if we had, just as an example, if we had, just to bring it into today, not worry so much about the 1997 or the rules at 2017, which we've now passed those times, but which is valid for people who hold properties across that. But the $500,000 property that's brand new today, bought today, $500,000 property that's second hand and maybe 30 years of age, both similar rentals, getting the same rent, let's say, and they're the same size. In other words, the properties are the same physical size. There's not one that's an apartment, there's one that's a house sort of thing.
A couple of things to consider there. One which is built today is going to have a much higher construction cost, which we've understood is going to be the basis of their claims. So to build a property today, we're looking at a much greater cost index than what it was to build a property 20 or 30 years ago. Prices only go up when it comes to building. So that property is 30 years old. Typically, we're going to be looking at somewhere maybe 1/3 of construction costs for what it would cost to build today. And you'd also be looking at the inavailability to actually make claims on those technical equipment items in there as well.
Sort of thing,
So the new property absolutely is going to stack up over and above the old 30-year-old property.
What's the definition, or when does a new property become second hand? So if you're a developer and you've got a new property that's been sitting there, and say you have a little bit of trouble selling it, a lot of developers turn around and say, well, we'll start to rent it out. And the moment they start to rent it out, does it then become second hand, and then I come along and buy it, and all of a sudden I'm buying a second hand property and I can't claim the...
Is that when the tenant moves in? Is it?
Well, you might have some questions around where they've held that property, whether it's held as trading stock or it's been held as an investment. To argue that point as to what is going to be in application to it. But definitely, if someone's been in there and they're cooking chooks in the oven, it's second hand.
The microwave test. There's always a microwave test.
It's the microwave clock being set. Maybe it's second hand.
I just had one question before we're going to take some questions that are coming through online. Tell us a little bit about your company, Capital Claims, and just the process, how easy or how hard it is for, how streamlined you have putting these claims through. If I come on and say, I've got a client, we need a depreciation report, how easy or how clunky is it online? Is it a form we fill in? Is it an editable PDF? Is it? What is
It's
it?
always easy. Basically, we don't expect individuals, accountants, or anyone else to be knowing of all the information that's required to prepare this report.
Mm-hmm.
We do a lot of legwork. There's never a silly question, as we established already. If you're not sure if there's deductions available or if there's something you're missing out on, you just ask us, and we're quite happy to do that via a phone call, hop onto our webpage and just send through an online request for an inquiry. There's so many ways to contact us, and happy to help with anyone.
Wonderful. I'd imagine you've got access to a lot of this sort of council data, so you know the date of construction, you know when it was started, when it was bought, when it was sold.
That's all part of that dark
Yeah,
art.
that's the dark arts.
That's right.
Alrighty. We've got a question here, Michael from Warners Bay. What if I replace a roof that was made of terracotta but had to be made tin as the tiles don't exist? Is that a repair or an improvement?
Okay. I'm assuming the terracotta tiles are being removed because the roof may be leaky, or there's some cracked tiles or some other way that it needs to be repaired. So in my consideration is, once again, we go back and see how long have you had this property for. If it's within the first, say, 12 months and it's starting to leak like a sieve, it's a good chance it's been doing that for a while, and then that'd be considered a capital improvement to put the tin on top. But if you've had it for quite a while and then the tiles are starting to crack up and lose their effectiveness, we may be able to argue, but once again, in the consideration of the
Yeah, look, my understanding is, again, you've got to return it back to its original condition, and once you start using different materials, that's when you're really moving towards an improvement, even though those original materials aren't available anymore. And chances are they're not available for a good reason, because they're not efficient in their use. So if tin is a by far superior product than terracotta, which I would imagine it would be because it doesn't damage or as much, it's an improvement. Yeah. There's a really interesting theoretical question around all this, and just let's say that you've got a tin roof and you're replacing it with a tin roof, and someone wants to go and replace the entire roof. If they just replace a couple of sheets this year, that's a repair, then a couple of sheets next year, and that's a repair. And you do this for about 4 or 5 years in a row. So after 5 years, you end up with a brand new roof.
Maybe slightly mismatched in colour.
Yeah, that's it. That's definitely an improvement, but it's only been a repair along the way, because all you've ever done is just replace the bits that have been missing. So it's an interesting.
The other question which arises is, it came as part of a storm. A storm came along and took half my roof off.
Yes.
How do we deal with that?
Yeah.
And then once again, we're looking at the relationship with the insurance company. The insurance company will be actually making some of these deductions available, and then you as an investor are able to make some deductions as well.
I can tell you now there's some very, very complex rules around insurances, and we're having to have a look at them now, especially around disasters, floods, droughts, fires. They're incredibly complex, more outside the scope of tonight's discussion. So
We digress.
Yeah. Any other questions? That's about it. I think that's it. Given the wind-up signal.
Yeah, so that's thanks very much tonight for joining us. Been working with Mark for about 12 years now, and he's been a really good source of information for us and worked with us in a lot of different areas, and always very good to ask questions to. So I just put that in because that's been really important to us growing as a company. But till next time, which is 3 weeks' time, we have a broker on, Donna McRae from Golden Arrow Finance, who will be our next live stream, and that's on the 29th of April. So thank you very much, Tony, and thank you very much, Mark, and we'll see you in 3 weeks' time.
Chat.
Thank you very much.
Thank you.